Join me in giving Kathy a very warm welcome.
Yeah.
Thank you. Can I take this one? All right. Good evening. I don't know how my voice is going to sound today. I don't know if it's going to sound that great. I went on the real estate guys cruise last week and came back with not a voice. So we'll get through it. All right. So we're going to talk about a lot of things that I did actually learn on the cruise. That it was a $10,000 cruise. So I'm giving it to you for pizza, the price of pizza tonight. But I think it's really valuable. It was some of it shocking. And so let's start with this. How many people think that we're going to see a continued economic expansion? Forever. Okay. How many think there might be something looming? Okay. All right. All right. So this won't be too shocking. But either way, we don't really know, do we? You know, I predicted a massive recession a couple years ago, and then Trump came into office, and I was completely wrong. So it does help. Did anybody get a little affected at all negatively in 2008? Anybody feel that? Yeah. So nobody wants to do that again, right? So we're 10 years older. Let's just not do that again. Okay, we're 10 years closer to retirement, so nobody needs to go through that again, except maybe some youngsters. Maybe you just need to go through that. I don't know, but you know, we need to be aware because it was kind of hard to tell last time. Although some people could see it really clearly, and don't you want to be that person, right? So I'll go over some of the things that. First of all, I have a lot of slides, and people take pictures, so you can just email slides@realwealthnetwork.com. We have the most amazing IT group, and I think when you do that, you actually get the slides immediately. So it's kind of cool. You can follow along on your phone. Okay. Whoop. So here's just a few things you probably already know. That our first, let's see, with President Bush, we went into $5 trillion in debt. It was doubled. No, it went from 5 trillion to 10. Was doubled, and then Obama went from 10 to 20 and doubled the debt. I mean, 20 trillion is a lot of dollars. I don't know how many it takes to stack up to the moon or something like that, but a lot. So it's a lot of money. It's hard to understand how much money that is, and we throw it around as if we know what it means, but we don't. What it basically means is I think every woman, every child, every human being in America would owe $350,000 or something like that. It's a lot of money. And now, since Trump has been in office, it's now up to 21 trillion and rising. Why would it be continuing to rise? You can't, well, yeah. I mean, a lot of the policies that got him in office cost money. That's the bottom line. If you're going to cut taxes, that's going to add to the debt. If you're going to have infrastructure spending, with no way to pay for that, that's going to add to the debt. So we're seeing the debt rise. And then when you add 10,000 baby boomers retiring every day, 10,000, we have a lot of liabilities that are unfunded. Some people say it's 85 trillion, some say it's as high as 200 trillion. Again, we don't, what's 1 trillion versus 200 trillion? I have no idea, a lot of money, but we don't know how to pay it. So these are just things that we've known for a while, and yet it's all looming. It's been there. The U.S. on the U.S. government's website or webpage, their stated pro forma, basically, is a net operating loss of $1.2 trillion. Like, could you imagine having a business that loses $1.2 trillion every year, and yet people still lend to it? Imagine having a business that loses $1 trillion a year and people are still buying bonds, thinking that's a safe bet. Like, I'm gonna lend money to this entity that's losing money, but that seems to be kind of the flavor of the year right now. Is companies don't seem to have to make money, and either do governments. $300 billion in debt auctioned off in 1 week. Like, who's buying this stuff? I don't know if they're buying it anymore. I don't know. 1 trillion funding requirement just this year. All right, so that's just some stuff. The state of Wall Street, 76% of companies that went public in 2017 were unprofitable, and most had never, ever seen a profit. So once again, amazing, right? Amazing that so many investors would buy these public companies when they IPO, when there's been no profit. Corporate debt's at an all-time high. 14% of 100 largest U.S. companies have interest expenses higher than their income. Yeah, that's terrifying. And $800 billion in corporate buybacks just this year. Last month was a record in corporate buybacks. The last time we had that, the last record, was 2007. Whatever that means. I have no idea what that means. So just something to pay attention to. All right. So here's why I care. And I look at the stuff. I'm not an economist, but I am an investor. And we are affected by these global decisions that are being made out of our control. And we can benefit from it. We can profit from some of the mistakes that our leaders are making. But we have to know what those mistakes are. We have to know what's happening in order to profit from it. And I didn't know. Back in 97, but totally by accident, my husband and I got married, not by accident. We actually intended to get married, but we bought a house that we got lucky. We got married in 97 and bought a house. We had no idea that it was the bottom of the market. It was a great time to buy. We didn't know. So we bought this huge house in Lafayette. It was $546,000. We turned it into a fourplex. We turned this little unit down. There was total house hacking. Turned the in-law unit into a unit, and over there was an office. And we basically lived on the entire top floor of this gorgeous brand new house for almost nothing. So that was, again, just kind of lucky. We didn't know real estate. We lived there, raised our kids there, and made $1.2 million, just doing nothing, just living there for practically free, renting out these rooms. That's how we learned investing. And that was really wonderful until 2 years later, it was worth $800,000. So I made over $1 million and lost over $1 million. And that was a bummer, but not terrible, because it was our home, and we lived there. But wouldn't it have been nice if we just sold it in 2007 or held it instead of selling it in 2010, which is what we did? So, again, you don't want to do that. You don't want to do that, right? So here is, and that's just one of many properties, by the way, that we had. And so a $1 million loss is a bummer, but times that by 5, and that's a big, big bummer. So that's why I'm here talking to you, because I've learned a lot, and I'm seeing a lot of the same trends, right? We're seeing some of the same trends today that were back then. Just like I said, the corporate buyback. That's interesting. That was the last peak was in 2007. So here is the S&P Case-Shiller Index, and you can see that home prices are back past their last peak, and that's nationwide. So what do you do? With all this, what do you do? Do you sell everything? Do you panic, or do you figure out how to profit, no matter where the market goes? And yes, that's the answer. So if you look here, you can see I don't know if this has a pointer, but back in 2006, California home prices were just totally peaked, right? They were, people were able to get loans for practically, just sign a piece of paper. There had to be no evidence whatsoever that you could repay it. It was really easy. I was a mortgage broker at the time, and I know how easy it was. I literally would have people come in, put flyers on my desk that would say, Nina loans. You know what those are? Anybody know what a Nina? No income, no asset. That's up to $5 million. Yeah, I would get these. Or CECL loan, stated income, stated assets. And so I literally could have given anyone a loan and made a lot of money. If I made 1 point on $1 million loan, that was $10,000 to me. If I charged 3 points, that's $30,000 for having someone fill out a form. It was really good business. Although I was very cautious because I did know that there was something wrong with that scenario. And so I would look at people and say, I'm not sure you can make this payment. And if they really, really couldn't, I wouldn't do the loan, and they would just go to the mortgage broker sitting next to me and get it. So anyone could get a loan. All right. So back then, that obviously drove prices up in California way past sustainability levels, because had anyone actually had to qualify, they wouldn't have had those homes, right? So the blue line is the peak for U.S. housing, and California was way above that. That red line is Texas. So Texas didn't take off. It wasn't going crazy. They had very strict lending laws at the time. As a loan broker, I hated doing Texas loans because they were so strict, and it served them well. They rode through that recession. So because I knew something was wrong, there we go. I had the Real Wealth show back then. I have it still today. Back then I was a lot less experienced. And so I would rely on people with experience. And that was the whole point of the Real Wealth show, was to teach me. I wanted, I had this great opportunity to have people with years of experience to tell me what was going on and to share their years of experience. And then, of course, our listeners got to benefit from that as well. So our audience grew really quickly because I got to have people like Robert Kiyosaki on, who had many more years experience than me. And so back in 2006, he said on the show, you got to sell everything in California. You just sell it. And he said, I'm buying in Texas because Texas is 26% undervalued in the residential market. And they haven't had this boom. They have solid loans there. You can't refi past 80% LTV. And so he was selling all of his California holdings and buying in Texas. So Rich and I jumped on a plane, went to Texas and bought 5 properties, $550,000 properties that rented for $1,500. It was like 1% of the purchase price. Came home, I talked about it on the Real Wealth show, and a lot of our listeners wanted to do that too. So we shared that information, the agent that we used and the area that we were investing in, and suddenly our phones were just ringing off the hook. Lots of people saw that made sense. And one lady that stands out to me owned 3 properties in Stockton that kind of looked like that. They were super rundown. They were constantly needing repair, just nickel and dime. She was barely making cash flow. She was renting them each for $1,200 a month, but not really cash flowing very much because every month something was breaking on one of the properties. And she came to me just exhausted, ready to retire at retirement age, hated her job, hated her boss, and just said, is there anything I can do? And I said, yeah, you can do what we just did. Sell those. I'll help you find 9 brand new properties in Dallas, and they rent for the same, and there'll be no nickel and diming because they're new, so there's nothing broken. So she did it. She sold her 3 properties. We helped her exchange it, get into 9 properties in this little town called Rockwall, a really cute little area. We chose Rockwall in Texas because we knew a new freeway was coming in that would make it 20 minutes to get into Dallas instead of an hour around the lake. So anytime you can get into an area where there's massive infrastructure changes coming, that's a sign. And so those houses, well, I'll tell you in a minute. So she basically tripled to quadrupled her cash flow and came into my office with a note, showed it to me, a note that she gave to her boss. She had just done that thing everybody wants to do. Is like, I'm done. I'm out of here. She was able to quit her job and retire. About a year later, maybe 18 months later, the market crashed. Her properties that she sold in Stockton were worth about $100,000. So whoever bought those did not have a similar story, right? And I remember I had people coming into my office same time saying, hey, I want to buy these properties, not these specific ones, but saying, hey, I want to buy these properties in Stockton. And I remember saying, that sounds like a lot of money for really low cash flow. Are you sure you want to do that? And I still remember the guy, and he's like, my wife doesn't want me to do it. And I'm like, yeah, listen to your wife. But he did. And so, this is why you want to know, right? The story it's a tale of two people, right? One person profited, one lost everything at the same time. So where are we today, and how is that similar? Well, what we know is that the U.S. population has grown by about 20 million people since then. Since 2008, it was 304 million, and then now over 20 million more. So we've got a population growth here. We have household formation as a result of that from a growing population. We also have millennials coming of age, the largest population in the U.S. today, and they are moving out and they're forming houses. Maybe there's 4 or 5 of them in a house, but they are forming houses. And we know that inventory levels have dropped because of all this demand and just not enough supply. Builders got absolutely wiped out in 2008. Their construction lines disappeared. They couldn't finish their projects. Many had taken massive leverage to buy land, and so builders got wiped out. It's taken a long time for them to get back up and running. That's created this lack of supply when there's this growing population. So there's massive demand for housing, low supply, high demand, driving up prices. So the one thing that we know is very, very, very different, and I'm just talking residential real estate at this time. How many of you are into residential real estate as an investment? Okay. How many prefer commercial? So I want to make sure that, all right, we'll talk a little bit about commercial. Right now I'm just talking residential because I think there's still just a really incredible opportunity in residential if you know what to look for. I forget what I was going to say, something about that. But, oh yeah, so the difference between now and before is that even though prices have gone up, it's a different reason. It's a better reason. Well, I don't know if it's a better reason, but it's not from bad loans, right? People have had to qualify for these loans. They've had to prove that they can afford to live in these houses. Anybody got a loan lately? Was it easy? It was not easy, right? It's not easy. So that's the difference, is people have truly had to qualify. About 30% of buyers paid cash. A lot were bought by investors and are now rental properties. So prices are up, but I don't personally see housing as a weak spot in the economy, because even though prices are up past the last peak, they're pretty solid. The market is pretty solid. The only thing that could really rock that is if all those people just lost their jobs, right? That would be an implosion, but that would affect a lot of things, right? All right, so another thing that could potentially affect the real estate market, at least in residential, is, well, for sure in residential or commercial, is interest rates. And we know they're rising. I look at them every day. I tried to do a refi last year on our home, actually, and we tried to build this deck. Anybody listen to this about my deck on my show? Anybody heard that? Oh, it's Malibu, so we just did it. Because if we tried to get permits, it would take years, and we got caught. So we've been waiting like 2.5 years to get this deck permitted, but we built it, so they haven't made us tear it down yet. So that's the good thing. But anyway, it's taken 2.5 years to get this thing permitted. So in the meantime, I was all set to get a refi at like 3.5% rates, and they're like, no, you can't until you have that deck done. And so anyway, every day I'm watching the rates go up, and we still don't have the deck done. Oh, anyway, that's why I look at rates. But, and because of cash flows, right? If you're buying property now, it's definitely affecting cash flows. Are you noticing that? It's we're maybe a little more picky than the average buyer, because we were looking at just the numbers, and it's affecting the numbers. So this is something we need to pay attention to. How high will they go? They've been pretty much just going up every week for the most part, and that has a lot to do with the bond yields, and I'll talk about that in some future slides. They're still really low, though. I mean, look at that chart. Historically speaking, those rates are low. So even though they're creeping up, still a really good time to lock in a rate, especially if they're going to continue. A lot of experts don't think that they will go out of control this year, maybe hit about 5%. But there are some factors that could really challenge interest rates in the future. And the biggest one, I don't remember if I put the slide in here, so I'll just tell you. You all know that the Fed is tapering now, right? They're reversing their policy. Is anybody not aware of that? So one of the reasons why rates have been so low is that the Fed has been buying bonds. And their bond buying it's created a market for buying bonds, because the Fed's buying them. We are basically buying these bonds, and when there's not a market for bonds, then the price has to go up. The yields have to go up. It has to become more interesting for anyone to buy it. Well, the Fed bought $4.5 trillion of them, and they decided this year that's enough. We're going to reverse it. So what we know is that the bond buying program stimulated housing and kept interest rates low. So what would be the effect of the reverse of that? So it's yeah. Well, they're reversing it. They're saying they're not going to do it, and they're raising the Fed fund rate. So these are two things that the Fed is doing with an intention to slow things down. So just notice it. And what has happened in the past when the Fed has done that? It slows down. So the intention is to slow things down, to curb inflation. When the markets get too heated, then the Fed's got to slow things down, and that's what's happening. So it's been a really great party. It's been an awesome party for about 10 years, and now that party's starting to come to an end. Now, I'm not saying that there's going to be a crash. I'm just saying that our government and the Fed, the Federal Reserve, which is not our government, but they work closely together, has a stated intention to slow things down, and we need to pay attention. All right, so again, home ownership is down, even though we've had these low rates. So what does that mean? That means that, well, I don't know what, this is the reason. 60% of the country did a survey with CNBC. Anybody see that? There was a survey where about 60% of Americans do not have $500 if there was an emergency. And I think it was 70% of Americans do not have $1,000 for an emergency. That's pretty terrifying, and that would tell you why maybe homeownership rates are down. Because if you don't have that for an emergency, you probably don't have it for a down payment either. So, putting all of these things together, it's like, what does this all mean? All right. So with every crisis, there's opportunity, right? With everything, there's an opportunity, as long as you understand. I was just on ABC News today, and they're like, what do you think about rent controls and the repeal of the Costa-Hawkins? And you familiar with that? You should be familiar with that. If anybody here own rental property in California, you definitely want to be familiar with this. There's anytime prices get high and rents get high, people freak out and don't like it. Of course, there's two sides, right? People who own homes are loving it, right? Or sitting on massive amounts of equity. Landlords loving it. Rents are going up. This is good for us. Who's it not good for? Who's angry? Renters and buyers, right? Renters and buyers. So are there more renters and buyers than owners and landlords? Possibly. I don't actually know the numbers, but all I know is that we live in a society where people vote. And so whoever has more wins, right? So if there's more renters, we're going to start to see laws that favor them. And so one of the things that is happening and is on the table right now in California is this Costa-Hawkins repeal, which would basically repeal this law that's in place. And I won't go into too many details, but you can't have rent control in single family or on multifamily built after 1995, I think. I don't know if I'm getting that right, something like that. And so if that's repealed, that means if you own a single family home, you could face rent control. I don't know if it's going to pass. It's basically something that's going to the public. Do you think the public will want that to pass? Renters will. So I literally had a woman call me yesterday, experienced investor, saying, I'm selling all 30 of my Sacramento properties because I just don't want to deal with this. She's like, which markets can I go and buy rental property and not have to face rent control? All right. So what do we do? Well, if you're into residential, then, you can really meet this incredible demand we have right now for affordable housing. That is a place you can be active for many years, no matter what happens in the future. What we know for sure is that people like to live indoors. For the most part. So if things go to hell and you've got affordable housing, there's probably a chance someone's going to want to buy that, especially if you have the right kind of property. What would that look like? Be a property in an area that's less affected by the kind of recession that could be coming, that's in the, maybe still in a good school district or in an area where people would still want to live even when times get tough, because there will always be demand for that rental housing. There should be another. All right, it must be coming up. Yeah, so that is a great opportunity today. And so there's 3 ways to protect yourself, knowing that there's a whole lot more than 3, but I'm just going to go over 3. So one is to reposition your portfolio, like I said, to kind of look at the opportunity you have today, just like my client back 10 years ago who said, I think I can do better. I've got these 3 Stockton properties, and they've got a ton of equity, but they're just not really performing. If I were to buy them today, they wouldn't make sense. I think that's what she was saying. Like, if I were to buy these today, it wouldn't make sense. I bought them a long time ago, and it does. But she realized she could sell them 1031 and get something better, higher cash flow and newer. That's really an opportunity you have to look at today. Is wow, if you own California property, you're probably sitting on some good equity. And if you're trying to buy California property, then you need to look at it really closely and make sure you understand the cash flow and compare it to cash flow you could get elsewhere. So you can reposition. And just like this woman from Stockton, that simple repositioning can change everything. For her, it was a difference between working for, a Hitler boss to being retired. And the place that she bought in Rockwell, those properties have tripled in value. So she never experienced the recession. She never felt it, barely went vacant, bought in a really nice area with really good schools. And because we knew so much growth was happening with the new freeway and all the jobs and all the population growth in Dallas, she's made a lot of money. She's done very well. Number 2, be very aware of leverage. So once again, you don't have to raise your hand, but did anybody get over leveraged in 2008? Because I will raise my hand. I was way over leveraged, way. So be careful of leverage. One of the biggest mistakes, there were a lot of mistakes made, but the reason why my company was able to pick up unbelievable deals in 2009, 2010 was because of other people who over leveraged. And those properties went back to the bank, and we were able to pick them up for very cheap. So you don't want to be that person. You want to be on the side that's going to pick up deals if that happens. So be cautious about over leverage. The biggest concern or the biggest fear I have for people right now is we get this amnesia at this time in the market and forget that in 2006 everything was awesome too, and before the internet crash, everything was awesome too. And in the 20s, everything was amazing until it wasn't. But usually things are incredible until they're not. Like it's like the best of the best of the best, and then boom. So it's at this kind of peak where everyone is just partying. You've got, like today, you've got kids going to Coachella paying $500 for a ticket, and then whatever it costs for the rest of the drugs you need for that. So, it's got to be $1,000 weekend at least. I don't know. Where are they getting the money? I don't know. So it feels a little like the 20s. My daughter just got back. I'm not naive. All right. So be aware of leverage, and I'll come back to even my own commercial property vetter came to me with a property yesterday and said, it's this amazing value add. It's in a great part of Atlanta. It's in an A neighborhood. It just needs some fixing up, and it's got like tax credits and like all these great things about this property. And I said, great, all that sounds fantastic. All I want to know is the leverage. Can we get into long-term debt? Because I'm not doing it if it's short-term debt. I won't do anything that balloons. And he's like, well, yeah, in 3 years, but it will be worth so much. But in 3 years after we redevelop it, we'll have to refi. I'm like, no, that's all I need to hear. Because where do you think we're going to be? Where do you think interest rates might be in 3 years? Does anybody have an idea? I don't know. I really don't know, but maybe higher. Maybe. maybe a lot higher. It depending on. I'm guessing. I mean, here's what I actually believe is that the pretend, the extend and pretend game will continue. That's what I think is going to happen, because that's the only thing that can happen. The only way we dug ourselves out of the last hole was the same problem, right? More debt. So we didn't fix the problem. We just created more of it. So I don't know that they can fix it. And I think the only way that the government's going to try to fix it is do what they did in 2008, which is more quantitative easing, which would devalue the dollar and create more debt. That's just the only solution. So it could be that there's a reversal and that they start buying bonds again, and that lowers interest rates, and then they print another $4 trillion and everybody's happy again. Everything's great for a little while. So that could be the next scenario. But at some point, they can't do that anymore. At some point, it's unsustainable. I don't know when that point is, and I don't want to get stuck in it. So my advice to you, are you doing any short-term debt? No. How long, what kind of loans are you getting in? 7.5. Okay. Yeah, I just be careful with that. I think there's going to be a bloodbath, honestly, in commercial and apartments, people who get into short-term loans. And then when they have to, when it comes time to get the new debt, if interest rates are higher, that's going to affect the NOI. That's going to affect the value of the property. They may have to put more money down. They may not have that money. So just, again, if you're getting into bigger deals, please try to negotiate. Fannie and Freddie have like long-term debt now for apartments. Get that. Pay more for that. Get that. That if you're going to get into apartments or commercial, get long-term debt or have a backup plan. We have a rental fund right now. A lot of our investors want to invest, but they just want to be passive. They're like, hey, I'm in retirement. I don't want to do anything. Just do it for me. So we started a rental fund, and we were going to get the fund financed, and it's short term. I don't want to do it. I'm not doing it. Unless we can get long-term debt, I'm not doing it. So be careful. The beautiful thing about single family is that you can lock it in at least up to 10 loans. Anybody reached your max on Fannie and Freddie loans for rental properties? I'm going to tell you right now, one of the best assets that you have right now is your credit. And to lock in a 30-year fixed rate loan on a single family home or a duplex or a fourplex, if you can lock that in at today's rates, which you saw are still low, that's a good loan. That's a loan you will not regret having. I mean, it would have been even better a few years ago at 3.5% or 4%, but it's still not bad at 5%. It's still good. And investors, you can get up to 10 loans. You can go to your mortgage broker and find out that you can qualify for 10 investor loans on your credit, 30-year fixed rate loans. You lock in that payment for 30 years. What do you think housing prices were 30 years ago? Anybody have any idea? 30 years ago, how old was I? I was old. It was a long time ago. All I know is my dad I grew up in Atherton, and that was a really fancy place to grow up, right? I was almost embarrassed to tell people I grew up in Atherton. Do you know what our house cost? You know, my dad paid for our house in Atherton. Oh no, that would have been the mansion next door. Yeah, this was 1 acre, one story, 5-bedroom on Santiago. What? He paid $99,000. Yep, we lived there. I grew up there, and it was still like a very nice neighborhood. So like we were still the rich kids, at that price point. So, is it possible that 30 years from now, I mean, maybe we're not going to see that kind of growth? Maybe we are. And can you imagine, especially given the trillions of dollars that's just been printed and all this debt, there's a good chance we'll see inflation. So imagine locking in today's rates, today's payments, and just watching values go up and rents go up, and you're just locked in. So if you haven't maximized your credit, I highly recommend you consider that and look into it. But like I said, good debt. Good debt, long-term debt. Don't get stuck in a balloon payment. And have lots of options. So let's talk about that. Yeah. As long as that is not, I mean, be careful of adjustable rates because they will be adjusting and probably up. But if you can get it fixed, sure. Yeah. I mean, the cheapest debt you can get is on your primary. That's how we got started. We just refied our primary, locked it in at low rates, and bought a bunch of property. And those properties performed so well in Texas. I didn't just stick to Texas though. I bought in Boise. So Boise's a great market, but there was like 2 employers, and after the recession there was 1, and I think it was the government. So anyway, that didn't go well for me. But I should have stuck to Texas because it was such a diverse economy. So much, I forget how many, 7 million people or something like that. Boise had 350,000. That's a small rental pool. So I've learned, get into an area that has a large rental pool, large and diverse economy. It's easier to get through tough times. All right, so population change. This map just kind of shows you, like, if you're looking at the next Texas prices have gone up. There's still some good deals there, but definitely prices have gone up. It's harder to get the cash flows. Still a good market though. If you look at this, you can see the blue is where people are moving. You got a lot of people moving to Texas, Florida, Nevada, Colorado, Utah for sure. A lot of Californians moving up to the northwest, although that's real hard to cash flow up there in Oregon and Washington. But you can see migration patterns, North Dakota, certainly oil and so forth. So this is just kind of an idea of where people are going. And then this is kind of an interesting report. Anybody seen the U-Haul traffic flow, this last one? So now U-Haul tends to be, it's the people who haul themselves. So it's these are, I would say, the more middle-class Americans. The number 1 place they're going is Texas, where they're moving, and number 2 is Florida, and number 50, the last place, California. Can you believe that? And then we're talking, I just saw a chart. The middle class is now less than 50% in California. Like the low income has risen and high income has risen, but middle class is disappearing. We're starting really to see that. And so they're leaving and want to have a good life somewhere else where they can afford to live. So if you want to cash in on that migration pattern, here's some of the places that we found have had really nice returns. And, if you haven't been to these areas, you just need to go and check out America. It's my job. I travel all the time. I love it. We have a big event we're holding in May 18th that might already be sold out, but check it out if you're interested in going. And anybody hear my Real Wealth show with Whitney? I interviewed her about what's going on in Detroit. It's fun to go to these cities and see how they're turning themselves around. Detroit, what's his name? Oh my gosh, I just interviewed him. Anyway. Dan? Yes, Dan. He's turning it around. I got to interview his assistant. I almost got him, but I'm not there yet. I'm working on it. Someday I'll get him. So Dan Gilbert, he's the founder of Quicken Loans, and he moved his company downtown to Detroit, and he's like, man, this place is on sale. So he bought 100 buildings, and he is completely turning around Detroit. Plus he just made another few billion, I think, from doing that. But I'm doing an event there so people can see, and that you can buy houses turnkey, renovated, rented for between $60,000 and $80,000. It's crazy. That's $12,000 down, and they rent for about 1.2% of purchase price. So if you paid $60,000, you'd probably rent for around $800 or something. And already, we started buying in Detroit last year, and it's gone up about 20% just in the year. They're still nowhere near where they were at the peak. So I love markets like that. We went into Cleveland when it was kind of where Detroit is today. It was just in the middle of its recovery, but still scary, still boarded up and lots of crime. But we went in, And Rich and I bought a lot of $35,000 houses, put in maybe 15, 20,000, ended up with $50,000, $60,000 houses, and they're worth double that now, just a few years later. And one guy's been paying $900 a month for years, same tenant, because Cleveland is a big medical hub, huge medical hub. It's got all of these. It's got the medical mart and the Cleveland Clinic. There's a whole downtown is all medical. It's like 3 or 4 universities just for medical. So you're almost guaranteed to rent to someone in the medical profession if you get in a nice neighborhood. And that's the case. We have a doctor renting. You might say, why on earth doesn't he own? I don't know. I don't care. He's lived there since we've owned that property. It's near the lake. They're completely revitalizing that downtown. So I love going there. And I went to Cleveland and I ate like vegan, organic downtown. It was the weirdest thing. I have never gone to Ohio and found something I could feel good about eating. Like really, I'm a Californian. And I remember one time I was on some crazy diet that, I had to have certain organic foods. I was on the Whole Life Challenge. I don't know if anyone's ever done that, but I had a very strict diet. I couldn't find anything. And this last time I went there, I'm telling you, like the person took me to this place that had I didn't know I wasn't in California. It was amazing. So these areas are really turning around. Huntsville, you know what's happening in Huntsville? Anybody know what the industry is there? Toyota moved there, yeah. And NASA, they build rockets. You can rent your house, your little $100,000 house, to a rocket scientist. It's amazing. And do you think our current administration is going to be feeding into that program? Yes. Yes, Donald Trump wants to increase our military. So these little military markets are going to be thriving. Jacksonville's another one. We love Jacksonville. Now, so in these markets, you're getting about 7 to 9% cash on cash, but if you finance, you can get into the 9 to 14% returns still. And then if you want to get into more growth markets, if you want to be in the sexier markets, you're going to have lower cash, you're going to get lower return, but you might get higher appreciation. I don't necessarily think that's true because we've seen so much appreciation in Detroit and Cleveland and Pittsburgh and these areas that never appreciate. But there's still a belief that these areas will appreciate more. So I'm still buying in Florida and Ohio and Michigan and just sort of balancing out the portfolio with sunny areas and I don't even know if you can call it the Rust Belt anymore. I don't know what it is anymore. It's coming around. All right, so on to leverage. So there is this, I already talked a lot about it, but does anybody invest in syndications? You know what okay, great. I'll just say what a syndication is, just in case you don't know. It is a group investment. So let's say that you want to be totally passive and Jean-Marc has got an apartment and you just give him $50,000 and he invests it for you, and but he's raising $8 million, so you're one of several hundred investors. That's a syndication. Okay, I'm gonna just take a glass of water. I got a little cold on that cruise ship. Do you guys like cruises? I'm not sure. I seem to always get sick afterwards. But went on the Real Estate Guys cruise. Have you guys heard about that? If you can go, I would go. You're literally having dinner with Peter Schiff and Robert Kiyosaki and Chris Martin. So it's amazing. It's too damn expensive. It is a lot of money. If you're between 18 and 25, it's only $2,500, and you can do a video and try to get a scholarship. But otherwise, it's like $7,500 for an individual and $10,000 for a couple. It's a lot of money, but I'll tell you what, like deals get done, people network. I think it pays for itself. It's really cool. I'm totally promoting. I get nothing from that, but I thought it was great, except that I keep getting sick afterwards. Anyway, all right. So with leverage, one of the things that happened in 2010, I have the Real Wealth Show, and that, first of all, I was on KSFO, and my husband said, there's this new thing called iTunes. You should put your show on that. This was a long time ago. Well, I don't even think it was called iTunes. It was just like some place you could put a podcast on an Apple thing. But it ended up being iTunes. So I was one of the first podcasts. And it went from being a local show to international overnight. And all of a sudden, I got a call, and this lady from Australia is like, come out, I want you to talk. America's falling apart, and we want to buy everything. So they like, great. Kick us when we're down. All right. So they flew me out. I talked to 1,000 investors. It was amazing, the power of the podcast. It was incredible. And then that led to us, Americans were down and out. So I had busloads of Australians that their dollar doubled, and our real estate was like 10 cents on the dollar, and they were killing it. It was crazy. So I had busloads, 50 Australians at a time, coming to the U.S. and buying stuff. And that got the attention of Goldman Sachs. And I ended up being honored as one of the top 100 most intriguing entrepreneurs by Goldman Sachs for the work that we were doing and getting all these investors to fix these neighborhoods. We were buying boarded up houses and cleaning up neighborhoods. And then that led to being debating Robert Shiller on CNBC. I really don't know how that happened. I was sitting on vacation and I got a call to be on Fox News to debate Robert Shiller. So all that notoriety kind of basically got me in the news, and builders started to come and say, hey, it sounds like you've got investors. We're finding these deals. Can you raise money? Like, I don't know. I'll try. And so this particular builder, he found this land in Florida that had been 160 million, and we could get it for 16 million. And he's like, we only need to raise 3. Can you raise 3 million? I don't know. And so I sent out an email, and we had 3 million. So we got into the syndication business. Don't do it that way. That is not the way you raise money, by the way. That is the illegal way to raise money. You have to actually have a private placement memorandum and an operating agreement. So I learned that after. You want to be very, very careful whenever raising money. If anyone invests in anything you're doing, there's a very good chance it's a security, and you fall under security law. And that goes far beyond real estate law. And if you do it wrong, you could get thrown in jail. You do not want to screw it up. So make sure if you're raising money or anyone's giving you money that they're investing passively, make sure you understand securities law. I've done lots of articles and shows on it. Happy to talk to you about it. But anyway, this builder comes and he is so cautious. So we've done a lot of deals together, but he keeps finding deals that are the result of somebody else getting over leveraged. Even today, I mean, we picked up this like 27 townhomes waterfront in Portland for, again, $3 million that had formerly been $20 million because somebody got into a hard money loan. And then somebody in Reno got into a hard money loan, and it came down to the last minute, and we needed to raise $16 million to take over the property. And we did it. We did it very quickly and took over this property in Reno and started building these homes. And one of the things that our builder is so, because we take over so many other people's properties who got into bad debt, is he just won't take debt. He's older now. He's in his late 60s. He's very successful. He's just not going to risk it. So one of the things that he makes sure, the reason we raised $16 million is we're not taking on bank debt at all. We're going to build the homes. We bought the land, entitled it, and we're going to build the homes with no bank debt so that we can never, ever get stuck in that position. And I say that in case you're an investor in someone else's deal, make sure you understand the way they've structured the debt so that you don't get yourself in trouble either. Okay, whoops. Another way that we structured this, because again, my partner, this is the same one since that, we've done a lot of deals. He's playing it so safe. There's so many ways that you can move forward in what's a very uncertain environment. We don't know if we're going to have an economic boom. We don't know if it's going to continue. We don't know if the Fed is going to print more money and keep the boom going. We don't know if we're going to have a massive crash. We don't know. So we have to structure things as if either way could happen. And just like the Stockton woman didn't know necessarily a crash was coming, but she structured her investment so that if one came, she'd be fine, and she was. And if there wasn't a crash, she'd be fine. So either way, it didn't matter, she'd be fine. So that's the way we're structuring our little deals and our big deals. So this one we bought, like I said, this is the Reno land, and this group, it took too long to entitle. Entitling long land is really hard to do. It means basically you got to get approval from the city to build, and it took too long. They had to get a hard money loan. That hard money loan, it took even longer. So they were about to get foreclosed on, and we came in and got a great deal on this land. But even so, our builder was like, I still don't want to take any risk in this market. I want to build homes, but what if the market changes? I don't want to be stuck like other builders were in 2008. So we took all of these lots. These are the lots close. This is Interstate 80. This is Boomtown, like the big casino. And you come right off. So we got the land that was it's already got the utilities coming. It's like it was just such an easy project. And then he decided to take these, which are the less desirable, smaller lots near the freeway, and sell them. And so we sold this whole group for the same price we paid for the entire thing. So now our investors are sitting on the remaining lots free and clear. That's a great position to be in, right? It's a great position. That means if there's a recession, we'll be okay. We sold homes. We were doing this in 2010. We were still selling homes. It just wasn't as quickly and not for as much. But if you're sitting on land free and clear, you can lower your prices, right? So these are just some ways you can structure things to make sure that whatever comes, you're going to be okay. And then finally, this is a project we're working on right now. We're going to probably do a tour to this is in Costa Rica. A New York City developer came to me and said, I want to raise my family in Costa Rica, and I want to build my dream community. And I want to know if you want to partner. And I was like, tell me more. So he found this land. It's 800 acres in Costa Rica. He's going to build like about 200 homes, some little tiny homes for people who just want a safe haven outside of the U.S., kind of more for political reasons, or if there's a massive economic meltdown, they just want to know they have a little tiny home somewhere. And then, or to visit, and then all the way up to luxurious, very nice homes. But we were able to do the same thing, buy the land for cash and sell off little lots, and selling off the little lots pays for the construction of everything. But even more so, what we've done to protect ourselves and our investors is have a whole lot of multiple exits and different strategies and different things you can do just in case things don't go as planned. So he planted 10,000 fruit trees, cacao and coconut and avocado. And so now we have an export business of organic food on the land. And our houses are being built now, but probably won't be selling until next year. So we put up 85 of these little tents. So it's glamping. Anybody heard of glamping? And so now we have like a functional operating business. Of course, it's a little easier to do that in Costa Rica. But we've got all this income now coming in, people holding retreats. He brought in a New York City chef, and the chef uses all the food that we're growing in the land and makes this really yummy food, and you can take cooking classes and yoga classes. And so we're getting an income while we're building the houses. So again, it's just kind of a neat way to make sure that there's enough options, enough opportunity, that you've just looked at it from every angle of possible failure, that it'll still work. And then here's just another one that the same Fred is the builder that we've done a lot of deals with. This is a different one than Costa Rica, but this one was a really cool structure that I just want to tell you because it may trigger some ideas for you. But he knew that Dublin, California, it had plans for total redevelopment. Like that was the one area left in the East Bay that just hadn't really been revitalized. And so the city of Dublin is in the process of making it a really cool place. But that word hadn't really gotten out yet. So that's another key is you want to know what's going on in city planners' offices. That is one of the most important things you can do. That is what we spend so much time on, and we share the research we've done on our website. If you join Real Wealth Network, you get access to that research because knowing what's happening will make you money. So he knew that Dublin was about to totally revitalize, but some guy who owned an office building didn't. He had no idea. So when Fred went to him and said, hey, you know, we want to buy your property, this guy didn't know what was happening to his neighborhood. He had no idea. He was sitting in the middle of this like hotbed of new growth and development. So we negotiated an amazing deal, $10 million to purchase the office building, but in a 2-year contract with a $1.2 million deposit, but we didn't have to close for 2 years. So in that 2-year process, we re-entitled the land to residential, and we're able to tear down the building and sell the lots, finish out the lots, and sell it to Pulte Homes for $20 million in that 2-year period. So all I had to do was raise $1.2 million. We didn't have to raise the 10. We were able to close on the $10 million deal with a $20 million deal. So the investors were pretty happy on that one. So again, another kind of creative structuring kind of way of doing it. One of the ways that we, again, this is for your knowledge, whether you're raising money from other people or investing in other deals. When in any of these kinds of projects, people can come in as an equity investor or as a lender, right? So you can take investors either on equity or on the loan side. It would be the best way to describe it if you're new to the concept is if we were going to go buy a house together and we were going to go 50-50 and you're going to put 50% of the money and I'm going to put 50% and we put the down payment, that's our equity. We're equity investors, and then we get a loan from you. You give us a loan for the rest, 80%. So if we make a bunch of money, we double the value of that property, we pay off the loan at 6% interest, and we get all the equity, and we split it, and it's awesome, and we made a bunch of money. What happens if we didn't? What if the values went down? We lost? We still have to pay that guy. So, you know, if you're really looking for safety, you want to probably come into deals as a private lender. You're going to maybe make a little less, but you're going to get paid first, right? No matter what happens. If you really believe in the project, then you want to come in as an equity partner. And that way, if there's a bunch of profit, you make it. If there's not, you don't. So there's a little more risk, but a lot of reward potentially. So you want to study it really well and understand the project if you're coming in as an equity investor. You still need to study it if you're coming in as a private lender and make sure you're at a low LTV. You don't want to end up like the banks in 2008 that had properties worth 10% of what they, had lent on. But that's one thing to look at. So in a capital structure on a deal, you've got secured debt is the highest priority. It gets paid first. Unsecured debt gets paid second. Preferred equity partners get paid third. And then the other equity partners get paid last. So that's why in all of our deals, we'll offer some as debt. So you can come in as debt. You get a little bit lower of an interest rate, still really good. And you get paid first. And then, we'll sometimes have unsecured debt, but then there'll be something called a preferred return. And the preferred return means that you get paid your capital back and your preferred return before the other equity investors get theirs. So when I partner with a developer, we put them here. We put them at the top. We basically say, you're not going to get any money until everybody gets paid. You don't get a penny. There might be management fees, small ones, because they've got to, feed themselves. But that's the way we structure it so that we know you better get this project done on time, on budget, or else you're not going to make any money. Because the longer it takes, the more money the secured debt and the preferred equity partners make. So again, if you're investing in other people's deals, make sure you understand the capital structure. Or if you're raising money. I'm not sure where we are on time. Am I okay? What time is it? I have a watch on. All right, I forgot. I can look at that. All right, so that was kind of the bigger JV stuff and syndications. But if you're starting out and you want to figure out how do I create a retirement, how do I just get started? This is the plan that I've helped a lot of people on this plan. I think this is a great strategy for locking in those 10 loans that you're able to get. If you've had any trouble buying California property, If you hear anybody whining about the fact that they can't get a property, tell them this strategy, because this to me is so exciting. It's a solution that people haven't thought of, and can change lives. I really mean that 100%. So if you buy, like I said, I'm going to say like that could be a Detroit home for $60,000, but let's just say $100,000 because it's an easier number to work with. So let's say that house is $100,000 and they're all over the country in nice up and coming areas. And you had to put $20,000 down. You would need about $250,000 to do this plan, but not all at once. You can start with 20. To buy an investment property, you need about 20%. So if it's a $100,000 property, we're talking $20,000. If it's a $60,000 property, we're talking $12,000, right? So you buy it, and you're shooting for about $300 a month cash flow net after all expenses. So $300 a month. Now, if you could buy another one and another one, if you can get up to buying 10 of these, and remember, on this property, that's an $80,000 loan, so we're talking about a $400 payment. You can still own $1 million portfolio, but you're qualifying for a $400 a month payment. And as a lender, as a former lender, when we look at something like this, we're going to count the rental income towards your income. That's not going to happen buying a house here. You're not going to have that. So this is a strategy that most people can do. People that are making $60,000, $70,000 a year can do this. So that's why this is kind of the strategy for anybody to become a millionaire. But you do need to save your money and get the capital. Or maybe you bought a property and you have that much money, you can sell and you can do this. So if you can if you can shoot for that $300 cash flow, now you have $3,000 a month cash flow on 10 homes that have been financed that you put about $250,000 in down payments. At the end of the year, that's like $36,000 in cash flow. If you took all of that $36,000 in cash flow and paid off house number one, remember the loan is $80,000. How quickly would you have that paid off? Like in about 2 years, you got a house free and clear. Now you have more cash flow because that debt's paid off. You pay off the second, you pay off the third, and when you accelerate the payoff of any loan, you can get it down to like 13 years. So you could have these homes paid off, and I'll be conservative and say 15 years, but it could be closer to 13, that you could have all of these homes paid off with someone else's money. You put the down payments in, and now you own $1 million portfolio free and clear. That cash flow is about $8,000 a month net. And if you buy right, those could double in value in that time. Yes.
Why would you recommend doing a 30-year loan as opposed to a 15-year?
That is such a good question. Well, just in case you run into hard times, yeah, you can get higher cash flow today. Go ahead and pay that 15-year payment. But let's say you run into hard times or you have a vacancy, you only have to make the 30-year, but you can make the 15-year payment. So if you can get a lower rate on a 15 and you feel real comfortable with that, that's fine. But just make sure you've got plenty of reserves. That's the only thing that really screws people up is over leverage. Just like I said, if you get in a situation where you can't pay that debt, you're in trouble. So have reserves, lots of reserves. Yes.
What percentage do you recommend for each property cash reserves?
I like to see 6 to 12 months of rental income per property. Oh yeah, sorry. How much reserve should you have? So is it possible that your properties will go vacant for 6 to 12 months? It's possible. It's probably not going to happen if you pick the right properties in the right neighborhoods and the right schools and your jobs and all of that, and you take good care of your properties and you're in a good market. But let's say you have an eviction and it takes a month or two, or something happens. It's just great to have that. That's treat anything like treat your real estate like a business. You wouldn't run a business without reserves. Real estate's a business. Make sure you've got plenty of reserves there. This is just to show you accelerated payoff of a 30-year note. If you put $1,000 on 100, I think this is a $100,000 loan. If you put $1,000 extra per year towards the equity principal, you can pay it off in 22 years. If you put an extra $2,500, you can pay it off in 17. And if you put an extra $5,000, you pay it off in 12. And that's why I was saying if you shoot for that $300 a month cash flow, you could pay it off a lot faster. All right. That's it for now. Thanks so much. And again, we do events every month in San Mateo, so just check it out, realwealthnetwork.com if you want to sign up, find out about those.
Cool. Okay. Thank you very much, Kathy Fettke. Everybody, let's hear it for Kathy one more time.